very, very quick on what's in the big, beautiful tax bill. Right now, it's just a teaser trailer, a quick wrap up on what you can expect for your 2025 or 2026 taxes from a planning perspective. I mean, for this year, you have to start planning now. So I thought it was important for us to touch base on it. So it was signed a couple of weeks ago, few weeks ago. Uh, a lot of cut. If you remember, when President Trump came last time, he had Tax Cut and Jobs Act, TCJA they called it in 2017. A lot of changes were expiring at the end of 25. Now, a lot of those changes, not everything, but a lot of those changes have been made permanent, meaning they will not be expiring. A lot of new changes have been added. If you look at it, tax rate was supposed to go back to 39.6% after this year. Now it's made permanent. The maximum tax rate is 37%. And I'm sure 37% seems high. 37%. But this tax rate is one of the lowest tax rate this country has seen. This country has seen up to 85% of income tax rate. So 37%, as high as it sounds, is still a very good lower tax rate. Child tax credit has been increased from $2,000 to $2,200. And the best part is it's $1,700 out of this $2,200 is a refundable credit. State tax rates have been increased from 30.99 to 15 million starting 2026. And a lot of talks about senior deduction for people 65 or more. There's a new deduction as $6,000. There are income limits. If you are making 75,000 or more as a single person, it phases out. Or for a married filing joint, if you are making more than 150,000, it phases out. It's a deduction, not an exemption though. So $6,000 for new deduction that was not there earlier. But it's meant for people over 65 million. 529 plans can now be used for multiple purposes, for homeschooling, which was not there, which was not allowed earlier, for books, and the amount that was 10,000 has been increased to 20,000. A lot of talks during the election about tip overtime. Tip income has been, there's a deduction around it. Again, it's not an assumption, it's a deduction up to $25,000. Again, there are income limits. If you are making 150,000 as a single person or 300,000 as a married filing joint person, it starts to phase out over time as a similar rule for single person. First 12,500 is not taxable. There's a deduction around it. For married filing joint are 25,000 of deduction, but again it phases out. If you are making more than $300,000 as married filing joint, your tip and overtime deductions will phase out. And a new deduction on auto loan for the autos that are assembled in the US up to $10,000, up to, meaning not 10,000 actual amount, or up to $10,000 on auto loan is deductible. Sold limit has been increased from 10,000 to 40,000, but it's not applicable for you. Most of you are making more than $500,000 anyway. So if you are making more than $500,000 married filing joint, the limit starts to phase out and goes back to $10,000 from $40,000. Section 199A reduction has been made permanent. So first 20% of your income is not taxed under QEI. There's a minimum deduction of $400 that has been added. As Dina mentioned, bonus depreciation has been changed from phased out to 100% depreciation. There are a lot of other changes in there, but in the interest of time, we'll skip some of these things. There are a lot of pros, a lot of benefits, a lot of disadvantages too. A lot of people are talking about the solar, but like anything else, it's a balancing act. When you try to make so many changes at the same time, you have to be concerned about how much it's going to cost to the country in 10 years plus. A lot of these changes are made permanent.